Hello, everybody. Welcome to the Real Collective Podcast. I am Brendan McKeigan. With me, as always, is Sean Tassé. Hope you're having a good time with the show. You can find us on Spotify. You can find us on Apple Podcasts and on YouTube if you just want to put it on in the background. We've got a great show lined up. We're going to start this year off right by talking about some things. A lot of people are upgrading their homes this year. So what we're going to do is we have a wonderful guest on the show. She's going to tell us all about things that you should be asking her, things that maybe you don't know to be asking her, things that are going to make it a lot easier and less stressful when you need to make the move to your new home. So today we have on the show Erica Vincelli from the Mortgage Advisors. Hi, Erica.
Hi, how are you?
I'm wonderful. Thank you for doing this.
Well, thank you for having me. I love talking about mortgages.
Yeah, I know. That's why I was like, I'm going to call Erica and save my voice a little bit today.
Just let me do all the talking.
Yeah, right. And it'll give Sean a break for the first time ever. Sean, how are you, my friend?
I'm happy to not have to talk as much. Welcome, friend of the podcast, friend of the show. It's nice to have you here, and I'm looking forward to hear some of your stories. So I'm excited.
Yeah, I appreciate it. Thank you.
Yeah. So what we want to cover today is maybe some of the top 5 questions. I'm sure there's more. Top 5 questions for your mortgage broker that you should be asking, maybe that you don't think to ask. So one of the one is, obviously it's the most simple one, but what's my first step? And today we're kind of talking more about, because we're seeing it more of people maybe upgrading their home. So that second home, that maybe forever home. So what's maybe the first step in that?
Well, the first step, I mean, it depends. Sometimes people call me first, sometimes they call you first, but I would really recommend guiding them over to me so that we can start having that conversation about the numbers. I would ask for a general idea of how much the property is worth, or how much you think you're going to be able to sell, which is kind of an interesting question in this market because so much is going, over asking, over the list price. So we'd really want to know how much the house is valued at, also what the balance of the existing mortgage is, because then we can use that delta for the down payment. Any changes to their financial profile since the last time they bought the house. So, do you have kids now? Have you branched off and started your own business? How do we calculate your income? So generally the application process is the same as it was the first time, but now we're including the sale factor of the property. So really the first thing is schedule a meeting with me so that we can go through the application thoroughly, update what needs to be updated, and then make a real strong plan and strategy for, is this a forever home? But what's coming up next in your life? The real big thing is that people are moving to a new home oftentimes because they're expanding a family, right? Let's just use the most obvious reason. So does that mean that you're going to be having to pay daycare costs for the next 3 to 5 years, which, as many of you know, are the equivalent of a mortgage payment? So we have to factor those numbers in. So the strategy becomes, let's keep the payments as low as possible. Let's stretch out the amortization as long as possible to keep that payment low. And then when, the kids are older and you have less money going out, you're right, you have lesser money going out to certain things when it comes to young children, then we can reevaluate the strategy and be more of a let's pay the house down faster. Now, that's really just one example. The strategy is going to always fit you, but we can play it on like what's coming up in your world, and how do we make the mortgage fit around your life.
That makes sense. Is it also the case that you're working with not just people who are upgrading their house, but people who have maybe already upgraded that house and are now seeing some huge gains over the last couple of years, and they want to pull that money out and buy another property, like stay in their house but buy an investment property?
That is the biggest piece of business right now that I find is coming down the pipe. Everybody's interested. A lot of people want to get into the real estate game, building a portfolio. So certainly, I mean, we can look at taking. Now, it's one of two things. I mean, in reality, if somebody is buying a starter home and they want to pull equity out and buy another home as a rental, typically, not always, but typically, if you bought a starter home, I would recommend taking that starter home, making that one into the rental property, because it'd be more rental friendly, as you guys would probably know. Like a townhouse, maybe easier to rent a condo townhouse than it is to rent a 4-bedroom house. I don't know that side of it. But if you're wanting to move into your forever home, then you can also refinance, take the equity out instead of selling it, and keeping that one as a rental, or buying another one as a rental. It's just going to change the amount of down payment that you're going to need for that. So if you move into the property, your down payment can be as little as 5% down payment. Obviously, that has to work within your debt servicing ratios. But if you're buying a house that's going to be buying a property that's going to be a rental, the minimum down payment is 20%. So that larger chunk might be a bit more difficult to obtain. It may or may not have enough equity in your home. So we might look at converting your existing property, which was essentially a starter home for you anyways, and make that into the rental, and then buy the bigger home, or sell the existing home if you need more of the equity from that property. And not everyone, trust me, not everyone wants to be a landlord. It is not always easy. It's great, but it's not always easy. I can speak from many stories from example, personal experience. But yeah, that's definitely something that's happening right now, because real estate is a really great investment, and Ottawa, in my opinion, is one of the safest markets.
And what kind of fees would like the average person maybe expect besides just, I'm buying a bigger house?
Yeah. So I'm just going to continue on the theme of we're selling this property to buy a new one to move up, because it could change. I mean, the fees might be the same, but let's just keep the theme the same. So in that case, we'd have to look at where are you in the term of your mortgage. This is a big one because we would be facing a penalty with the existing lender. Just so everybody is aware, this is a misconception. No lender will pay your penalty. Let me say that again. No lender will pay your penalty. If a lender suggests that they're going to pay your penalty, you will be paying them back in one way or another. So no lender will pay your penalty. I'm just going to say it. So you want to make sure that the penalty is calculated, so that when I'm, calculating numbers, we look at that, either reach out to the lender directly, or I can do a calculation. The thing is that it's always an assumption or an estimate until we have the paper, the black and white in front of us. But that's a huge one. There's also a discharge fee that goes along with any time you leave one lender and go to another one. So that would be part of the penalty cost. The land transfer tax, you're not going to get a rebate as a second or third multiple time home buyer. It's only on your first one. So in fact, when lenders ask for closing costs or confirmation of closing costs, that when you bought your first home, the lender in the commitment said, we want to see 1.5% of available funds to be used for closing costs. I have never, ever, ever used 1.5%. I actually do a disclosure form that requires you to show you that you could be paying up to 2 to 2.5% of the purchase price. The first home, you're going to get a rebate, so it kind of falls in the 1.5. But generally speaking, anytime I bought a home, the calculation is always almost 2.5%. So you really want to have enough money saved up. So when you say you've got $50,000 for a down payment or $50,000 of equity, I'm all of a sudden going to take 2% of what what we're looking at the purchase price. Take that out of the down payment right away, because that's really, really crucial. You do not want to be at the final hour and come up with money. That's a terrible feeling. So there would be that. If you have a large enough down payment, in most cases, you'll also have to pay for an appraisal. That will be coming out of your pocket up front, because the lender wants to get the appraisal. The lender's asking for it, but you have to pay for it. It's not actually technically considered your property. It's the lender's property, because it's for the purpose of the mortgage, but the client is paying for it. So that would be another expense. Those right now are between maybe $500 and $700. Those have gone up in price in the last couple of years with higher demand, as we all know what higher demand creates. Those would be the most common expenses. So penalty from leaving the lender, the closing costs, which you would have for buying any home, and depending on how high your mortgage, or depending on your down payment, the appraisal costs.
That's perfect. Yeah. And speaking of that as well, of extra costs, the one thing that you'll be able to explain better than I can, but I recommend to all my clients to get themselves a bridge loan. Some of them don't even know what that is, but that's basically when you own both properties for a short amount of time to make that transfer a little bit easier.
Yeah. hugely highly recommend a bridge loan. Okay, so this would be technically another expense, but I'll explain how it works because it's not an expense coming out of your pocket, keep in mind. So a bridge loan, essentially a bridge loan is a second mortgage on your existing property that will bridge the down payment amount, so the delta between what you sell your house for and what the balance of your mortgage is. Okay, so that's the equity, and they're going to bridge that to the new property so that you can have your down payment before the existing house is already sold. Now, the caveat with a bridge loan is that you have to have a firm sales and purchase agreement for both properties. Okay, you can't not have your existing house not sold yet. It has to be sold firm. So you have to have 2 existing purchase and sales agreements on both properties. Generally speaking, most lenders will have a bridge loan option within their lending institution, but not all of them do. And so if you don't, we'd have to go to a private lender. It'll cost more money, but it's still, I'm serious when I say it is worth its weight in gold, because I have seen some horror stories with clients that want to close on the exact same day. So they set their sale price, their sale date, and their purchase date are on the same day. That can wreak havoc if the left hand doesn't talk to the right hand. And there's so many hands in that pot on those final days that if something goes sideways, it can be catastrophic and cost you way more money and way more stress and time. And in my opinion, time and stress have way more value than money mostly. So basically what you're doing is you're buying your house before the sale date of the sale property. And so in that amount of time, so let's say whether it's 1 day, and I even recommend if it's 1 day or 30 days or whatever, the lender charges a flat fee of somewhere in the range of $450. And then they charge prime on average. Okay, so prime plus 4%. So we're thinking maybe 6.5% right now on the amount that you are bridging. So if you need a bridge loan of $25,000 or $150,000, you're only paying the interest only amount of prime plus 4 on the loaned amount, not the whole house, not the whole mortgage, just the loan amount. Anytime I've done this calculation, it is not a lot of money, period. I mean, if you go into 2-3 months, it's a different story. But if you're doing a bridge loan for $100,000 for 3 days, I probably estimate that it'd be less than $1,000, and it is worth so much money. And then once the money is transferred over, the payment itself, so the cost of it will be deducted by the advance. So it's no money out of your pocket, but so it would be an additional fee to add to the fee list, but it is such an important and useful product that it's really, really, I get really nervous when someone does not take a bridge loan. I highly recommend it when you're selling a house and buying one.
We've seen it before where if one, like you said, left hand talking to the right hand, if one doesn't close, it sort of has this domino effect where the next one is dependent on this one and the next one is dependent on this one. And so if the first person who's required to close, who didn't get a bridge loan, who's trying to do both on the same day, messes it up, they run the risk of not knocking down their domino and so forth, and it has the risk of coming all back to them and them getting in a lot more hot water than maybe $1,000, right?
For sure. In fact, it's not even sometimes your file, like you're just saying, it's not your file that's causing the issue. I had a client last year in the height of everything, and I said, I really recommend a bridge loan, and she did it. I'm really happy. I'm really, really proud and honored when my clients take my advice in that manner. And so our mortgage funded because she bought a property, and then she called me and she said, oh, by the way, thanks for that bridge loan recommendation. Turns out that the buyer of her property didn't get the financing in time. And so it caused like a 4-day delay. And I said, Mike, do you know what a 4-day delay would have caused your sellers for the house that you bought? Like, I mean, I had this conversation and it's crazy. So yeah, really highly recommend. Don't be afraid of that cost, because staying up at night for stress is brutal. Like, what would you pay someone in the middle of the night to go to sleep when you're stressed out? Put it that way.
And even just those little things too, of like when you buy a new house, I mean, we always tell people typically, 1 to 3% of the purchase price of the house you'll spend on maintenance, upgrades, whatever, within the first couple of years. But maybe you want to get in there and do a renovation for a week. Maybe you want to get in there and do that quick.
Clean.
Yeah, just exactly. Clean, paint, just basic
Yeah.
things. So
Yeah. Or just not the stress of having to do things like, what if the movers don't show up? Like, there's a million reasons why a bridge loan has value, but just also wanting to get in there ahead of time, like you said, and enjoy the space and move at a calm pace, like having to get everything done in one day, it's terrible. So yeah, really recommend.
yeah, no, thank you. I know that's going to be the case when I move, whenever we do get our house, because I want to do some just minor stuff. Bridge loans, highly recommended. For rates, I mean, we've got fixed, we've got variable. Me being not a numbers guy, I see them as just two words. So what's give us a little simple breakdown, like a fixed rate, variable rate. Some people might say they have a preference, but I guess it kind of depends on the situation.
Well, a lot of times I hear people, I don't want to take chances. I just want to go with the fixed rate. And I get that. I mean, we've been in reality, and I'm going to say something, I don't want anyone to take offense to this, but we've been kind of conditioned to go with the safe route. The safe route is safe, but it's going to make the bank more money than it's going to save you in the long run. And I can't say that this is 100% of the 100% of the time. Okay. Like, generally speaking, but if you look at history, the variable rate really does save people a lot of money. So, well, a fixed rate is just going to be one same payment every single payment. Okay, so it's never going to change. And a variable rate is going to be tied to what's called prime. And right now, prime is 2.45. And then you have what's called a surplus, like a prime plus or prime minus. Okay, so lines of credit or the bridge loan, I just said prime plus 4. And right now with mortgage rates, it's an average of prime minus 100 or prime minus 85. So that means whatever prime is, you minus 85. 0.85, and that becomes your rate. Okay, so the discount becomes the contract rate for the term, not the actual end rate, the net rate. So really, I mean, the risk with variable is that if prime goes up, then you're going to be paying more. If prime goes down, you're going to be paying less. So really what I suggest to people is, first off, there's no wrong answer. That, there's no shame in anyone's game. If you want to do something, if it feels right to you, then do it. That's going to be my first and foremost, my advice to anybody. But I really like to educate people on their options. And so quite frankly, I would be giving them information on both of the rates. But I don't really care about the rate number. I care about what the payment is, because you can tell someone this is my rate, but if you have $1 million mortgage or $200,000 mortgage, it matters what your payment is. So I talk in numbers, not percentages. But I think it really is important to understand, if you're going to use a variable rate, what's the strategy behind it? I don't really like calling myself a mortgage agent. I like calling myself a strategist, because what I like to do is look at, what is it that your plan is? I mentioned this early on. Do you have children? Are you growing a family? Are you going to start branching off and be self-employed? Do you need cash flow? So what are some of the objectives and the goals that you have? And how can we make each rate work for you? And right now, what I'm suggesting, with the variable discount being so much lower than the fixed rate, and in some cases, 1% to 1.5%. So if we can give you a variable rate, pay the equivalent of what the fixed rate would have been. So now you're tackling your prepayment options. You're paying your principal balance down faster. So you're saving on interest. You're paying down your principal balance. When rates do go up, which they will, I'm not going to sugarcoat it. We're in a rising rate market right now, because they've just been so low for so long. It's unsustainable. But when they do go up, you've already been paying a higher rate, so you don't have that much and you've already been ahead of the game because of all the savings. So when the rates start to climb, and let's say, in a year and a half, 2 years from now, your variable rate is equivalent to what you would have been paying on the fixed, it's not exactly even, because you've been saving so much money already by paying lower interest and tackling your principal balance. So it actually has to keep climbing for it to actually be at a break even. And a huge advantage with a variable rate over a fixed rate is that it's always 3 months interest as a penalty versus a fixed rate where it is a calculation of interest rate differential. We call it IRD. In English, what that means is a percentage of the interest that the lender's losing for you breaking your mortgage early. I've seen interest rate differential or IRD penalties as high as $20,000. I've also seen them so low that the lender will pay you'll have to pay the 3-month interest penalty because it's whichever one is higher. But IRD is often much higher, especially with major banks because they have posted rates and discounts. I can go on and on, but I don't want to go sideways on this. So it's just really important to know, it's not just about the rate. It's about what your strategy is, what your long-term goals are, planning for planning for life, because life interrupts life all of the time, and you never know. I mean, there could be moving up, growing a family, and then 5 years you separate from your partner. That's a reality too. So you just want to be mindful of the big picture and the overall cost of your mortgage. You don't have to worry about that. I do that. I worry about your overall cost of mortgage. That's why my clients love me so much. But it's something that you really want to consider. So just looking at the lowest rate, like, oh, this bank gave me the lowest fixed rate. How's that going to help you in the future, though? So really have to have that extensive conversation.
Right on. And you were talking about the rising rates and how that's probably what's going to happen because it's inevitable. I know, right? What do you,
we've been loving these low rates.
Do you have any sort of prediction on that, like where we're headed, where we might be headed?
My crystal ball,
no,
sorry, it's not here, man. Sorry. No, so the fact is that they're so low. They can only go up. But
right.
At the end of it, we know that they're going to go up if you plan for it. Right now, what I'm doing with a lot of my clients that are looking to either move up, more specifically, people that want to refinance, that sort of thing, I'm telling them, like, let's lock in a rate now. Because at the end of the day, you want to hold this rate. If you're going to refinance and let's buy that rental property, let's hold the rate now and do something, but we have 120 days to do it so that we can secure today's rate. The rates are going to go up. How high they're going to go? There's so much sensational media headlines right now with so many topics. I mean, we guess we can all agree to that. But one being the rates, that I saw one that says Bank of Canada is going to raise their rates by 500%. And I'm like, is that insane or what? And don't forget, Bank of Canada is what ties to prime as well. So it's not the fixed rate's going to go up to, high like that. But there's really no way of knowing. Things are changing all the time. I mean, they're going to go up. Just that the market is strong. That's really what I say about it. I don't like to get too confusing about how high rates are going to go because there's just no way of knowing. I mean, no one saw a pandemic coming and rates going down. And right before that, we saw a claim that rates are going up again. So, they go up, they go down, buy a house, sell a house, get a mortgage, pay off your mortgage. That's just what we do.
Do your thing.
Good answer, right?
It's interesting because one of the things you said earlier is, it's not just the rate that matters. It's all of the other pieces that go to it. So like you said, some people get so focused on what the rates are going to do as the one piece of entry into this conversation, when in reality, there's so much more to it. And one thing that I like to do is I try and look at what 10-year fixed is to give me a good indication of what, the people who know this stuff and study all of these numbers think about, like, really long term. And 10-year money is still really cheap. So, I mean, it sort of says that rates can't go up that much that quickly, right? In my mind, maybe I'm way wrong.
Yeah, I mean, I've seen 10-year rates at, right now I think they're a little high. I think that there's too much that can change in 5 years. So I don't really generally, especially because the first 5 years of anything over a 5-year term, so 7 or 10 years, the first 5 years, the penalty is really, really high. After 5 years and a day, the penalty changes to 3 months interest only. So it doesn't matter. So my concern with a higher rate, like securing that, is that there's too many things that can happen in that amount of time that your penalty would be so high that you will not save money in the long run. And that's my biggest goal for people, is that how much money can I save you upfront and down the road as well. So that's where I'd be a little bit hesitant, but I understand your idea, because because you're saying, well, could rates get to that point? Again, I mean, we didn't see this happening, right? I still have no one would have seen a 0.99% variable interest rate for 3 years. I never thought I would see alternative rates at 3.5%. I never thought I'd see private rates at 6.99%. So they've come down, they go up. We just have to, you got to ride the wave, and that's what it is. That's how I see it. I just don't focus too much on rates either. And there's so much, when you see in the newspaper, like rates are going up. So going back to the whole variable thing, when I tell my clients, if they want to do variable and they're a little uncomfortable with it, first off, do what you're comfortable with first, right? But if they do decide to do it, I say to them, anytime you see newspapers or articles or blogs or whatever that talk about rates going up, just give me a call and we can have that conversation. Like, I'm here for you after your mortgage funds, so that we can appease that concern for you and look at what other options are out there. But it is a marketing thing. A lot of, they put, half-page newspaper articles saying that rates are going to go up, when in reality, I mean, it could be sponsored by a particular bank. Maybe it's a good idea. Maybe it's a marketing thing. So got to be mindful of the source too. So
absolutely. Perfect. We're going to take a quick break, everybody. Let you all digest what just happened and take all of that rate info, mortgage info. Check out this video and we will be right back.
All right, you beautiful people, it is January 2022. It's a brand new year. Naturally, we're taking a look back at what happened in December 2021, as well as the year at large. Some real big shakeups, some changes that happened in real estate. So if you're enjoying what you're seeing here, as always, feel free to like, subscribe to the channel, share it with your friends if there's anybody who you think might be interested in moving this year. And there's tons of great content, new listing videos that we're putting on a regular basis, weekly podcasts with Brendan and I in them. So feel free to have a look at some of the other stuff that's on there. But without further ado, let's just jump right into it. Month combined, so we're talking about the month of December. We sold 862 houses. It's a decrease of 13.5%. But of course, the reason it is a decrease of 13.5% is because we sold so many houses towards the end of 2020, because the beginning of 2020 was essentially locked down, as you all remember. However, the average price of a house went up by 15.8%. This is both of a home and condo in Ottawa. So the average price, as you can see there, between the two at $615. Inventory, this is the name of the game, okay? We're talking about 16.1% less properties available for sale, 806, both homes and condos at the end of December 2021. We're starting to feel a bit of a pinch in January 2022, starting to feel like the prices are going up as a result. And you can see November 2021, we had 1336, so a drastic drop coming through there. Okay, number of sales, you can see 28 days of inventory. It's 4 weeks worth of inventory, not even a full month. So definitely a heavy seller's market going on right now. Year to date, so where did we land for all of 2021? Well, we set a new record. We've never sold 20,000 properties in Ottawa in one calendar year, and we did it. So it's an increase of 7.1% over 2020, which again was an increased year where we sold more homes than we ever had at 18,953. All right. The average price of a home went up by 22% in Ottawa, okay, for the entire year, which is amazing. And that's both homes and condos. So in 2020, the average price went up by 19.9. In 2022, the average price went up by 22%. So pretty drastic increases on both accounts. As you can see, the first year we talked about this, Ottawa sold more than 20,000 houses. Big milestone. We're also breaking records, price records. The forecast for 2022 is more of the same, even given the fact that we still have all of these constraints with regard to low inventory levels. We don't expect that the inventory levels are going to go up high enough to offset the pressure that's being put on house prices. So we'll break it down. We'll talk about the residential side before we talk about the condo side. So on the residential side, we sold 15% less homes. Again, that's because 2020 was really backloaded with regards to the number of houses that were sold. But the average price went up in December to 17.6%, from 603 to 709, you can see there. Again, inventory is really low. There's almost nothing to choose from at the end of December. 562 houses. At the end of November, you can see it was 929. So a really significant decrease. December 2020, we had what felt like a really small group of houses to choose from, while it's even less at the end of 2021. And again, we're feeling those constraints in January, in the new year. And again, you can see it's definitely a seller's market. 4 weeks worth of inventory. That is not a lot of homes to choose from. Okay. Year to date on the residential side, again, set some records. We've never sold over 15,000 residential properties in 1 year in Ottawa. Well, we did it this year. Okay. 6.1%. The average residential price, and I'm sure you've seen this if you're paying attention to what's going on in Ottawa real estate. Average residential price in Ottawa is $719,605. Last year it was $582, and we just thought that was bananas as far as prices go, but even still, that's an increase of 23.6%. So big changes happening here. The residential properties almost went up by 25%. I'd called for 30%, while some other predictors were calling for 10 or 11%. So no solution to the inventory issue. The government's talking about how they're going to implement changes to tax the money that people are making with houses. But I think the real solution to the problem that we're having about the prices jumping up so quickly is there isn't enough inventory. We need to force builders to build more homes more quickly. Even if they started building all of the homes right now, it would still take at least 18 months before they would start to come to the market. So we're expecting upward pressure to maintain on house prices into 2022. Okay. On the condo side, we sold less condos in the month of December, but the average price went up by 12%. Again, we've got some fluctuations that we saw from last month. We've been starting to track what's happening in terms of pricing on condos because there's been some really weird stuff going on. Number of houses, the condos sold, again, it's lower. The reason it's lower is because this was on the last slide. Sorry, the number it's lower is because we had a bigger 2020 at the end of the year. Inventory is much less, significantly less. At the end of 2020, we were seeing the condo numbers of units creeping up. And we're not noticing that now, okay? We're noticing them going down at the end of the year. And you can see it was 407 at the end of November. It's 244 at the end of December, so not a lot. Again, 4 weeks of inventory. We sold less houses in December, so even though we've got less inventory, we also had less sales. That will change as the year rolls on. Year to date on the condo side, we almost sold 5,000 condos, just a little bit under. It seems as though chances are in 2022 we will sell over 5,000. But again, that's a 10% increase in terms of number of condos sold year to date, and it's a 16.1% increase in terms of the average price of a condo in Ottawa. So this is October. We noticed that $20,000 dip in terms of pricing, average condo prices, and then was made up in November. It went up by 27,000, and then December saw another $30,000 drop. So it's an interesting yo-yo effect that we noticed in that monthly average condo price, because we're talking about a $400,000 price point here. So $30,000 is it's no slouch of a number, and we're talking selling 2, 3, maybe 400 condos in a year. In a month. You can't have that big of an effect without having something else going on. So we'll keep watching what's happening. A few people that I've spoken with said that might be as a result of what's happening with the price point of the condos that are selling. So, but it's just weird that it would be changing that much month over month. Anyways, if you guys like what you saw here, if you found it interesting, if you know anybody who's thinking about moving and you want to share this with them, as always, feel free to like the channel, subscribe to the channel, share it with your friends, and check out some of the other neat stuff that we're doing. There's a blooper reel up on the channel that's a lot of fun to watch. So if you're thinking about moving or investing, or you'd like to buy or sell, if it's a condo, whether it's a house, whatever it looks like, if you just want to chit chat about real estate, we can do that too. Happy to do it. The team and I be always happy to help. As always, feel free to give us a call. The phone number, 1-888-REAL-585, or hit up with a DM. And until then, keep it real, collective.
Welcome back, everybody, to the Real Collective podcast. We do have our special guest, Erica Vincelli, on the show. If you're enjoying the show, please give us a like and a subscribe and a share on everything that you're watching this on, whether it's YouTube, whether you're listening to us on Apple Podcasts or Spotify. That would be wonderful. We're going to do a quick little second half of the show here, which is more like a second eighth. Who knows? But we're going to talk about it. We've got mortgage wins. Let's talk about some of these, because a lot of times people get overwhelmed with the mortgage thought process and how it goes and numbers, and it just looks like beautiful mind kind of all over the place. So let's go over maybe a couple of wins that you've had that you're especially proud of, because I know you've helped out a few of my clients, and they have ranted and raved about your services, and that's why we are friends and work together. So let's dive into that. Let's dive into that.
Well, all of my mortgages are wins. I'm really happy and proud of all my mortgages and all my clients. And I'm really grateful that I found this amazing industry to be able to help people. The ones that come to mind a lot are often the ones where I've cleaned up a lot of messes in many cases. And so one of my clients came to me recently and they said, oh my God, we're closing our mortgage in 2 weeks. And, we bought this house a couple of weeks ago. We were pre-approved with our bank, and now we're finding out we're not approved. And that is a very scary feeling. And in reality, I mean, pre-approvals are a very interesting topic on their own. In my opinion, they're really not worth more the paper that they're written on, because unless you're giving all of your documents upfront to a lender to review and analyze and give you, like an approval, then you're not actually approved. Someone's just, plugged in a few numbers and given you like the go ahead to go and probably secured a rate. That's what really a pre-approval is a rate hold. So these clients, I said, okay, well, what documents did you give them up front? And they said, well, they didn't ask for us. They just told us that we could buy this house. That is an incredibly scary feeling for somebody who has waived their financing condition because they thought, or they probably didn't have one, to be honest, because of the market that we had last year, right? So they come to me and I'm like, okay, well, let's get her done. So I filled out an application really quickly. I was able to go to, I collected all of the documents. I analyzed the documents. Unfortunately, they didn't actually qualify on their own. We were able to get a co-signer to come on really quickly. I explained how the co-signer works. We can do it for short term. And then we were able to get it in front of a lender. The lender approved it. And to the lender's credit, they were able to fund in about 2 weeks, which is actually very difficult too, especially in a very high pace. Like everyone was working at their max last year and the last 2 years. So I was really impressed with the lender. I was really impressed with the clients. I was really grateful for the co-signer. But just, words wise, the fact is that just because you have a pre-approval, in my opinion, it's a false sense of confidence. Make sure that you've provided your documents to the mortgage professional, that they've reviewed it, you understand your application, you understand what your credit is, and then that way you know that you're confidently buying a house. So we were able to, take a negative situation and make it into a positive. They still rant and rave about me in the most amazing ways. I get referrals from them all the time because they're like, just go directly to Erica, save yourself the time and stress. So that one I was really proud of, because it's just this young couple, they were, stressed out to the max overnight and everything. So it was really, really scary, but we were able to make it work. And I was really happy about that one. So that's a good win. I'm trying to think. It's also, I have to be careful because I don't want to talk about private information when I talk about mortgages. But some scary stuff that can happen with mortgages is, at the last minute. So for example, we had a client who they were great. They did a great job, but there was in the last moment, so depending on how much time goes by from the day that you bought the house to the day that you fund the mortgage, the lender has the right to recheck credit. Okay, so if you buy it, let's say January, but you're not closing until April, that's sufficient amount of time that things can change with your credit, and the lender has the right to recheck it again. And what happened in this case is someone went out and bought something on their credit card that, like a car. I can't remember the details, but anyway, they changed their credit and the credit went down. So the credit went down. They didn't actually, it wasn't a car, because they bought something and it affects their credit because they missed a payment or something like that. So their credit went down and the credit went below what was able to be accepted for this mortgage. And so that is like massively scary in the 11th hour. We're in front of the solicitor at this point, where at this point, my job is done. So I step back and I let the solicitor take over, or the lawyer take over. And I get a message from the underwriter saying that they did a final audit and the credit went down. And we just had to figure something out. So we were able to figure out that other income wasn't being used in the original application. So we were able to use child tax credit from one. in the end, we made it work. But again, this was done, like we basically did a whole new mortgage in 4 days. And it was really, really scary. So this is a really important lesson. When I tell my clients, do not change your financial profile between the time you buy the house and the time you move into the house, it's imperative, because missing a payment can change things. Adding debt can change things. So it was a really, really tough lesson to learn. But in the end, we got it done. And I'm really proud of my team and the, the real estate, my team and the lawyer and everyone that was able to make it work. But a really hard lesson to learn for sure.
I'm still baffled at how many people don't explain to their client, how many realtors don't explain to their clients, hey, now that you've got a pre-approval or that you're about to buy a house, don't go buy a truck. And it happens so often that people are like, well, I need a new house. I need a new car to put in the driveway. So
it's insane. I actually ask my clients to, like, if I see that they don't have a car payment, if I see that they have very low owing on their car, I ask them, is there a new car on the horizon? And most of the time it's no, like, oh no, we've had this one, or we bought it cash, or we're going to keep this one for another 5 years. But there's been cases where they're like, actually my car is a box and we need to go buy a brand new vehicle. So I'm going to actually use a fake payment in the application, not for the lenders, they don't need to know that business, but for us, because I want to make sure that you're living a great life and you're not, house poor. You don't want to be eating cat food, gourmet cat food or not, when you move into this house. So, we want to make sure that your budget is I'm very mindful about people's budgets. So yeah, you just don't change anything. Just don't do anything. Now, people message me all the time, oh, can I go buy an appliance? Can I use my credit card? I need gas. Yes, you can continue to use your credit at a regular manner, but you don't want to just go crazy and change your profile, change jobs. I've seen someone change, hey, is it okay if I change my job? No. Day after closing, sure, do whatever you want.
And the last thing I want to get a sense of is we've seen some appraisals as the market's moving so rapidly and changing with seasonality. We've seen some appraisals that we expect to appraise at a certain value, typically at least what it sells for, and then they don't hit. Have you had to overcome that challenge anytime recently?
I am so grateful that I have not had that problem. I've had 2 times appraisals not come in at value. So for one, the appraisers also have to factor in the market itself. So if there is, like the market that we just had where things were going over asking, there was that element of value that was incorporated into the value. Okay, so they know that we're in this market and that's what the value is going to be. I had one very rural property that came in short, and what we did is we actually just changed lenders because, long story short, we ended up changing lenders. We changed insurers because it was the mortgage default insurer that did the appraisal. We didn't even need an appraisal on the new with the new insurer, and we got that one done. So that was easy. The other one, this one was interesting because this one was in Quebec, and the appraiser was not really being fair, we thought. And then once we started analyzing the MLS and the details of the appraisal, because it came in short, was what I'm trying to get at. We realized, and then I sent it to another appraiser, which I'm actually not allowed doing. I didn't know that at the time because I'm not supposed to see this. Oops, beg for forgiveness instead of ask permission. Turns out that the original appraiser missed a whole room. So an appraiser goes in, he or she sees the house, and they actually missed a whole room above the garage. So the second appraiser is like, well, the square footage is different, and this number and then this number. So we actually were able, on exception, be able to get it reappraised, and we got the value we wanted. Now, if the value comes in lower on the appraisal, the client is expected to pay that out of pocket. So if you get an appraisal for 300 and you bought it for 310, the lender is only going to do the mortgage based on the 300 value. And so you have to then decide, coming up with that extra 10 grand, which was super scary in the market with no conditions of financing. Because I told my clients, I can save you and protect you all I can on an application, but once an appraiser comes into play, there's not much I have no control over that. So that's why it's so imperative to make sure the values, that the realtors really are confident with the values, because it can cost a lot of money. But in the end, I haven't had a lot of problems, nothing that we weren't able to overcome. And I was really happy about that.
Awesome.
Cool. Well, we're going to wrap things up for today. I'm sure we're going to have Erica back because there are way more things to do and talk about and learn about, especially if you're me or like me. So we want to thank Erica for being on the show today. Erica, what's the best way for people to get a hold of you?
The best way would be by email. It's erica@ericavincellimortgage.ca. My website is ericavincellimortgage.ca. Those would be the best ways to get in touch with me. Email, because I just sit in front of a computer all the time, or I have my phone and my computer. That would be the best way. And my team and I, we can handle any mortgage you need.
Perfect. We'll make sure to put that in the comments below on the YouTube channel. And if you're looking for it on one of the other ones, it's Erica Vincelli, Vincelli.
Yes. Good one.
Yeah, thanks. Took me a while. But there's everybody. That is the Real Collective Podcast. Again, don't forget to like, subscribe, and share us on YouTube, and download us on Apple Podcasts and Spotify. I'm Brendan McKeigan. This is Sean Tassé and Erica Vincelli. We'll see you next time. Goodbye.